Welcome to our comprehensive guide on market risk. Today, we're delving into what market risk is, its types, and how you can manage it effectively. By the end, you'll have a clearer understanding of how market risk impacts your investments, supported by real-world examples and data. Market risk, also known as systematic risk, refers to the potential for an investor to experience losses due to factors that affect the overall performance of the financial markets. Unlike unsystematic risk, which can be mitigated through diversification, market risk cannot be eliminated because it is linked to the broader market movements. There are four primary types of market risk: equity risk, interest rate risk, currency risk, and commodity risk. Let's first take a look at equity risk. This type of risk is associated with the volatility in stock prices, which is affected by a myriad of factors including economic indicators, political events, and market sentiment. For example, consider the impact of a sudden economic recession on stock markets globally. During the 2008 financial crisis, the S&P 500 index lost about 37% of its value. Investors holding a diversified portfolio of stocks still face significant losses due to the pulling down of the entire market. Next, let's discuss interest rate risk. This risk arises from the possibility of a change in interest rates, which directly affects the value of fixed income investments such as bonds. When interest rates rise, bond prices typically fall and vice versa. To illustrate, suppose you hold a 10-year bond with a fixed interest rate of 3%. If the market interest rate rises to 4%, the price of your bond would decrease because new bonds are now issued at a higher rate, making your bond less attractive. Currency risk, also known as exchange rate risk, arises from changes in the value of one currency relative to another. This risk particularly affects investors who hold international investments, as fluctuations in exchange rates can significantly impact the returns from those investments. For instance, if you are an investor based in the United States and you have invested in European stocks, a depreciation of the euro against the US dollar will lead to lower returns when converted back into USD. Lastly, we have commodity risk, which is the risk of price changes in commodities that can directly impact the value of investments tied to them. This type of risk is especially relevant for sectors like agriculture, mining, and energy. An example of commodity risk can be illustrated by the fluctuation in oil prices. During the COVID-19 pandemic, the price of crude oil dramatically fell due to decreased demand and oversupply. This had a significant impact on investments in the energy sector. Understanding market risk is fundamental, but knowing how to measure and manage it is equally important. Two common ways to measure market risk are value at risk, VaR, and beta. Value at risk estimates the maximum potential loss of an investment portfolio over a specified time period, given normal market conditions. For example, a one-day VaR of $1 million at a 95% confidence level means there is a 95% chance that the portfolio will not lose more than $1 million in a single day. Beta, on the other hand, measures the sensitivity of a stock's returns relative to the overall market. A beta higher than 1 indicates that the stock is more volatile than the market, while a beta less than 1 suggests it is less volatile. Consider a stock with a beta of 1.2. If the market moves up by 10%, one would expect the stock to move up by 12%. Conversely, if the market declines by 10%, the stock would be expected to decline by 12%. Now, let's move on to how investors can manage market risk. Diversification remains one of the most effective strategies. Even though it cannot eliminate market risk, spreading investments across different asset classes can help mitigate the impact of specific risks. Another strategy involves the use of hedging techniques. Investors can use options, futures, and other derivative instruments to protect their portfolios against adverse market movements. For instance, an investor holding a significant portion of a stock can buy put options to protect against a potential decline in that stock's price. Another common technique is using stop-loss orders. This allows investors to set a specific price level at which their holdings will be sold automatically, limiting the losses in a declining market. Let's summarize what we've covered so far. We defined market risk and discussed its 4 types: equity, interest rate, currency, and commodity risk. We examined how to measure market risk using methods like value at risk and beta. Finally, we explored different strategies to manage market risk, including diversification, hedging, and stop-loss orders. We hope this tutorial has offered you valuable insights into market risk. Remember, understanding and managing market risk is crucial for making informed investment decisions. If you have any questions, feel free to leave them in the comments section below. Don't forget to like, share, and subscribe for more in-depth financial tutorials. Thank you for watching and happy investing.